Hello, everyone, and welcome to the Buck Stops here. I'm Catherine Murray. We are rounding out 2022, and one of the best performing sectors in stocks, of course, has been the energy sector. So I wanted to provide perspective in terms of where we go from here into 2023. Who better than to give us insight other than Eric Nutall? He is a partner and senior portfolio manager at Ninepoint Partners. Erica, great to be with you, and thanks so much for your time today. I know it's busy rounding out and wrapping up 2022, so thank you very
You bet.
much.
Always happy to be with you.
Thank you. Eric, this has been one of the best performing sectors in stocks. I think it surprised so many people. So many people have not been invested in energy for years. You have. I actually have as well since 2018. I think the question is, though, does it continue into 2023? What's your big picture perspective here?
Yeah, it's a fair question. It's the same question I got asked this time last year after a very, very strong year. We think we're in a multi-year bull market for oil. We've revisited the reasons for that. We just think there's a structural imbalance between supply growth and demand growth going forward. We were up about 45, 46% this year. But I feel disappointed in that. And I honestly thought it'd be even better than that when we look at valuations, when we look at the macro backdrop. We've had headwinds this year to battle. If anything, I underestimated how effective the U.S. administration would be at attacking the oil price, i.e., the gasoline price, heading into the midterm election with the biggest release from its strategic political reserves or petroleum reserves in history. 180 million barrels supposedly to counteract the impact of what was happening in Russia and Russian losses, which we never saw. So we had these massive headwinds this year, many of which we can talk about today, that are all ending. We've got China opening up. It's going to be a gradual, very bumpy process probably, but we're talking 1.5 million barrels per day of demand normalization. We've got the SPR release ending in a week's time. We've got now the impact on Russian production. Finally, we're seeing their exports fall by about 500,000 barrels per day, month over month. So many of those headwinds that we battled this year are ending. And so, yeah, we're up, 46%. We look at to 2023. We still believe in $100 oil. We think the macro backdrop remains very, very favorable. But even if you believe in where oil trades today, we see very meaningful upside in stocks where they're trading at about 19, 20% free cash flow yields. This year was all about deleveraging. So next year, more meaningful dividends, more meaningful buybacks, i.e. driving that re-rating. So yeah, I'm very, very bullish about not just next year, but the next several years. It's going to be a gradual process of these stocks being re-rated and trading closer to where we see more proper and fair valuation.
And a lot to pick up on there, including the re-rating of the stocks, because I think that investors are still not quite into the energy trade, and you can see that as it relates to the percentage that energy as a sector represents on the S&P 500, correct?
Yeah, absolutely. We're about 5% right now of the S&P 500, so that's down versus 10. Even TSX weighting is about half of where it was versus prior highs. And so when you think about, okay, well, what should an investor want? An investor should want to get paid, and they get paid through excess free cash flow, and through buybacks and dividends. There's no other sector that is generating the amount of free cash flow than the energy sector today. There's no other sector that has paid down debt and delevered so quickly to put them in the position to reward shareholders. And so when we look at both the micro and the macro, so the macro for oil very positive despite a likely recession in certain geographies next year. So the macro remains favorable. And from the micro, meaning the position that these companies are in from a deleveraging perspective now and able to not grow, not have to pay down debt, but instead have this wall of free cash flow. And the only proper usage for that is to give back to their shareholders and reward them for what's been a tough go for the past 10 years. We've had a couple of good years,
Yeah.
but it's been a tough place to be. So now it's our time to get paid.
It's been a tough 10 years. There's no doubt about it. And I'm really curious, Eric, because of that fact, there's a lot of people, portfolio managers said, I'm not going to cover energy anymore, or hedge funds or what have you, saying we don't really need an energy PM anymore, to the point where there aren't that many energy PMs out there, portfolio managers such as yourself. Are you getting more calls from institutions saying, hey, I got to at least have some exposure here? Are you getting calls from the States? Are you getting more inflows? I know from a retail perspective, you probably do, but what about some of the big players saying, I got to get into this trade, this investment?
Yeah, we're now the third largest energy fund in the world, and we see, generally speaking, inflows, institutional interest. We signed our first institutional client this year, so all the signs I've wanted to see are there for an inflection in the interest in the sector.
Okay, we'll take a quick break. We'll be right back. Eric, that's congratulations on getting the institutional client. I think that it's interesting to point out that maybe we are at an inflection point for the sector. I mean, we have seen a few good years, but it has been a very painful trade for most people for well over a decade. Let's just dig into the details a little bit here, though. In terms of the demand dynamics, particularly with China opening up, what if the case is that the Omicron virus or COVID continues to spread within that country, and as they open up and travel, that actually could have some demand destruction if, in fact, we get a whole nother wave. I mean, I'm putting that out there, but what do you
Sure.
think of that as a pushback?
Yeah, it's reasonable. We're gonna have to see how it plays out. You're seeing domestic jet demand up, I think 80%, albeit from the lows. But you have an inflection in jet demand. Road mobility, I don't think is being impacted all that much. So it's going to be a balance between those two factors. Seasonally Q1 is usually the weakest for global demand anyway. So this is really a Q2 and onwards call. In the short term, none of us truly know. But I looked to 2023, and when it comes from a demand perspective, China is by far the most important swing consumer. And so what we've seen is all throughout this year, despite the biggest release from SBRs in history, global inventories have been falling. And we track that using Kepler data, which is satellites that track every visible storage tank on the planet plus ships. So when I looked at 2023, we've already been undersupplied despite the U.S. administration's best efforts to prevent that. Inventories have been falling, and China's been suppressed. Look to next year, China's 1.5 million, SPR is about 8. So that's over a 2 million barrel per day inflection in supply plus demand. And so when this narrative around a recession and whatnot, I can't find a credible economist who's calling for a repeat of 2008, 2009. During that time, demand fell by 2 million barrels per day. So this maniacal fear that people have about, my God, we're heading into a recession, demand's going to fall for oil, energy stocks going to fall. I just listed two factors that could completely negate the demand destruction, even if we repeat an 08, 09 situation, which you and I both lived through. And so,
Yeah.
that to me, that's creating a really good setup for next year.
And where does OPEC Plus fit into the equation today?
Yeah, so I'm actually traveling over to Saudi to meet with some very high-ranking officials in a few weeks' time. Going to be interesting. Get to see Saudi Aramco, so the only company with meaningful spare capacity that I think will be extinguished or exhausted next year. They've
Really?
pulled
Why?
back.
How
So
so?
they were there a few months ago before they did the cut, two OPEC meetings ago. So it's the same theme, the chronic underinvestment in new supply for these members, where you're talking 80 to 90% of their state revenue comes from oil. When oil fell into the 60s, they're burning cash. They're below where they need to fiscally break even as a nation. The last thing you can cut is social spending, because you can't risk violating that social contract with your populace, because it's not like a democracy where when we vote Trudeau out of office, he's going to go get a job that pays him 10 times what he makes now. If you're a ruler in these countries and you get voted out of office, your ending is much, much worse than that. So the easiest thing to cut during that time is spending on new productive capacity. And so what we've seen is all of OPEC exhausting their capacity outside of Saudi Arabia and UAE. They're both adding about 1 million barrels per day each, but it's not coming online until 2025 and 2027. And so it's the reason why, again, I say we're in this multi-year bull market for oil. Why is it multi-year? It's cycle time. How long does it take to bring on new supply? So we're not even as an industry at a point where companies are spending. Once they get there, you've got to wait 4 to 6 years to see that production come online. So that's why this investment, this energy trade, has longevity to it.
Well, and it's interesting as well because, so many companies that you're talking about have been underinvested, and they were really, quite frankly, pushed to do so, whether it was the dynamics within the energy sector and or all the pushback from ESG and the environmentalists. They really didn't have much of a choice. have we heard from many of those CEOs that they are looking to really even increase capacity?
Absolutely not. You look at the drop off in oil. We look at inflation next year. Inflation is going to be up another 10 to 20%. So that's neutralizing your bang for your buck for capex. But the biggest pushback that these CEOs are getting are from guys like me. That again, we have clients. Our fiduciary duty is to make them money. What's the surest way to achieve that? It's by having them maximize free cash flow, buy back their stock aggressively, and drive that re-rating. There's not an energy investor on this planet that wants production growth. They want to get paid in the form of variable dividends and share buybacks.
Hmm. And they are doing that. I mean, you are, if you're an energy investor, getting special dividends along the way. We've seen it. We're going to take a quick break. We'll be right back. Eric, we've talked a little bit about the global dynamics that set us up for a multi-year, investment in the energy sector. Let's talk a little bit though about what's going on within North America and the energy policies in the United States as well as Canada and how that sets us up. When I think about the United States and the issue that they have in terms of fighting inflation, as we do here in Canada as well, I do wonder what the administration might be able to do to alleviate some of that pressure. What are your thoughts there?
Yeah, I don't think the administration can be effective at inducing supply growth out of shale producers for a variety of reasons. They tried, number one, this year, unsuccessfully. Two, investors themselves, who are the owners of the businesses, do not want production growth. Thirdly, what we're seeing is inflation, 10 to 20%. So that's neutralizing the effectiveness of increasing capex. And we're also seeing, from a geological perspective, inventory challenges. So shale wells. So when we talk about shale, there's only really three basins in the United States. You've got the Eagle Ford, the Bakken, and the Permian. The Bakken is basically like low to no growth. Eagle Ford is flat, and the Permian is the only area growing. But in that basin, what we're seeing is well productivity. So when you adjust for lateral length and all these different things, well results are getting worse. And so what that speaks to is the maturity of that basin. And so if you're getting less for the same well that you're drilling, it gets harder and harder and harder to drill. And it also speaks to how these companies have been exhausting what's called their tier one inventory. So their very best acreage, the most productive acreage, and now they're having to incrementally move to tier two and tier three. So there's bigger challenges than just the president picking up the phone, calling the CEO of company XYZ and saying, "Hey, I want you to grow."
Right.
So we see shale growth capped
They try
at
though.
about,
They
well, they
try,
can try.
right?
Oh
They
God, they
try,
try. Absolutely.
but it doesn't work.
And
It doesn't work like that.
not so much. Yeah. So we think shale growth is capped at about 500,000 barrels per day. Why that is profoundly important is that without shale growth over the past 10 years, non-OPEC production would have been flat, while demand's grown by over 10 million barrels per day. So shale has been the biggest game in town, and that growth, the era of hyper growth, is no more.
So let's talk then about the relationship between the United States and Canada as well, and really taking a look at our energy policy. And maybe we should even just take a look at the pipeline policy right now, because it seems that we want to make sure the pipeline between Michigan and Canada is open and works, and yet we don't necessarily use pipelines across Canada to service Canadians across Canada, correct?
Yeah. Yeah, energy policymakers, both on both sides of the border, still suffer from profound energy ignorance. Canada, we still import roughly 140, 160,000 barrels per day of foreign oil. The last time I checked, it's something like 20 or $30 billion that we could be transferring to our provinces, and instead we're transferring to other nations. And that's provincial politics, with Quebec being anti-oil, generally speaking, not allowing the energy's pipeline to cross the border. You look at the U.S., they could have sanctioned Keystone XL or approved it. Biden kills it, and now he's calling up Venezuela and other Middle Eastern nations begging for oil. And so there's just it's laughable in terms of how ignorant it is. Canada produces oil to the highest environmental standards of anywhere in the world, the most ethical barrel, etc. We've had that conversation many times. Nobody can say anything other. And so how can you possibly think, well, gee, we're going to call up Venezuela instead of Canada? So there's a breakdown in the logic to that I still do not understand.
You know, It's, well, I think, in some ways, we know if we import it from the East Coast, there's refineries there that benefit versus if we transport it across Canada, correct?
Yeah, that's fair. They'd be getting perhaps cheaper feedstock. But when we look at going forward, it comes down to again this mistaken belief that the end of oil is looming. We're all going to be driving EVs. We're not going to need oil, and therefore we can get by in a couple of years. And so long as we transition, we don't need more pipelines. So that's completely foolish.
And I think more CEOs are actually saying that. I think Jamie Dimon, in fact, was on CNBC talking about that as well, just saying like, look, the two can coexist, and it's going to take time for us to get to environmentally friendly or EVs solely. But it's going to take a lot longer than people were anticipating. So we almost need to work together now to ensure that we don't have the high inflation that really does impact everybody. What's so curious to me is if we actually were perhaps more kind to our energy and commodity industries within Canada, I really wonder what the revenue would be that we could then put towards our schools and our hospitals here.
Absolutely.
Do you
Well,
know what
this
we're missing
this
out on? Do you know what the
yeah
dollar
40.
figure is?
Well, we're paying $40 billion this year. It's probably going to be 60 billion next. It could be meaningfully higher. We could quantify that in the next bit.
I just think it's so important for Canadians to realize, and I've had other conversations with guests about this, that, our biggest resource for revenue to support all of the things that we love here in Canada, education, healthcare system, you name it. That's what we're trying to do. But you do need the revenue, and it does come from the commodity sector. So, I hope people start to understand that in greater detail and in greater depth. So thank you for your comments on that. Putting this all together, though, I want to get your take for our viewers in terms of how you would play the energy sector in 2023. Where do you want to invest?
Yeah. So I think broad strokes, you want to still remain in Canada. Our stocks remain mispriced. There are concerns about TMX and takeaway capacity. We've got the differentials for Canadian oil blown out. I think those are going to be rectified over the next several months and quarters. But I want to stay in Canada. I want to stay in oil over natural gas, oil over services. And I want to be in the mid guys, the mid caps, because that's where we're seeing this inflection point where they've achieved their leverage targets and they have promised to the world that they will be returning anywhere from 50 to 100% of their free cash flow next year. And so when we look at that, well, what does that mean? At $80 oil, if I look at the average holding in my fund, my average holding at an oil price, basically where we trade today, is at a 19% free cash flow yield. So three quarters of that, that's 15%, either in the form of a dividend, share buyback, or some combination thereof. And so why that's important is that next year, that in my mind, that's the catalyst to drive the re-rating, because will a stock stay at a 15% dividend yield if people think it's sustainable? I think not. I think it gets re-rated closer down to 10%. If we go fast forward, dare to dream in $100 oil, which I think we'll see next year, at $100 oil, my average holdings trading at a 30% free cash flow yield. So again, three quarters of that, you're now in the 20% dividend yield or 20% buyback. So a company able to privatize, in effectively 3.3 years. So that next year is really important. People have been patient this year. They've been waiting and waiting and waiting as companies have been paying down debt. Next year we're there. So when we look at Canadian mid caps, which we think are profoundly mispriced, big weights for us would be Tamarack Valley, Baytex, Headwater, three companies in the Clearwater play, which is the most economic play in North America. These are wells that pay out in months, so it's like phenomenally profitable, and people just don't appreciate that. We want to be in the oil sands. The biggest opportunity, once people realize that we'll be using oil for the rest of our lifetimes, that I can buy into these companies where they're trading at free cash yields of anywhere from 20 to 30%. So a name like a MEG, a Cenovus, where I'm getting decades worth of inventory for free. So that's to me a generational opportunity that I think we will get re-rated at some point next year. So that's generally where I want to be. I'm avoiding natural gas. I think we're going to be, I've got to call weather in that, but I think if you adjust for normal weather, we're in an oversupplied state next year with production growth in the US. So, gas prices could come off. And services, what we're seeing is most of the fleets are in poor condition. So they require working capital to restore their integrity. So the free cash flow
Mm.
yields that some companies are saying, I just don't believe that I'm going to get that return to me. I think you're going to get capex creep. So in my mind, the surest way where we can extract maximum upside, where I think next year could potentially be a better year than this year, despite energy stocks up 45%, is finally seeing these mid caps return the excess free cash flow. And where I can still buy companies trading less than 2 times their cash flow, that's at 100. At 80, they'd be trading at
Hmm.
3 when they used to trade at 8. So that's the
Hmm.
catalyst next year that I see.
Interesting. I would have thought, though, that the services side might have a bit of a bump, just given the fact that you need the services companies um, if you're going to be going long oil as well.
Well, the relationship between rising oil, rising cash flow, and rising capex is broken because of guys like me saying, your stock, as a producer, your stock is not guaranteed to go up if you're growing production, but it's almost guaranteed in my mind to go up if you buy back, 25% of your stock outstanding in a single year and tell the street, well, we're going to do it next year, we're going to do it next year, and you force that re-rating. So like
Hmm.
everything generally speaking looks good. Natural gas stocks even look good with a challenge backdrop. Service stocks look good, but what looks the best? Like where can I have the
Okay.
highest confidence with my clients' money? And it's investing in companies with low to no debt, decades worth of inventory, trading at a third of their historical multiples, generating the most amount of free cash flow in their history, and pledging to return that back to my clients in
Hmm.
the form of very, very big dividends and buybacks.
Sounds like a good setup. Last word to you, and thank you very much for being with us. For those who haven't participated yet in the energy sector, you say what?
The party's just getting going.
Okay, we'll leave it there, Eric. Great to see you. Thank you so much, and thank you everybody for watching.